What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone, brought to you by the Pulis Group. Today, we're going to talk about cost segregation studies and how you can really maximize the benefits to using a cost seg study. So a cost segregation study is the process of reallocating the cost of a property you're building among the various building components. So values assigned to the personal property, 5 and 7 year property, and land improvements, the 15-year property, which are depreciated at a faster rate than the building itself. So you remember, residential real estate buildings are depreciated over 27 and a half years. Non-residential real estate is depreciated over 39 years. So by allocating the building costs to the shorter life assets, your personal property and land improvements, you're getting more depreciation deductions in earlier years. So a cost segregation study generally handled with an engineering-based study, especially when you're dealing with larger properties. That's the best approach. That's the approach the IRS likes to see, unless you actually have constructed the building and have access to those cost records, then that would be like the top number one level. However, most people, they buy a building and they haven't actually built it themselves. So the next best thing is an engineering-based study. Now, there are online tools where you can perform like a mini cost seg, for lack of a better word, for smaller properties like a single family home. And they'll generally use a statistical pool from cost segs that they've done. Or they may come in if they fly a drone over the property, check it out. They'll generally do a quick site visit, but they're not going to be as in-depth, which is okay for smaller properties, but the best bet is to have an engineering-based study if the cost makes sense relative to the cost of your building. Now, when you buy a piece of real estate, remember what you're buying is the building and the land. So within the value of the building, so first you're going to allocate the building and land value. So that's either done using the sales agreement, you can have an appraisal done, or you can even use the property tax records and assign a value to land based on the percentage of land valued in those property tax records. Not as efficient as the allocation in a sales agreement or an appraisal, but it's still doable, especially for smaller properties. So what we're looking at here with the cost seg study is just that value assigned to the building. Because when you buy the building, you're buying all the personal property that comes with it, all the land improvements that come with it. But without a cost seg study, what generally happens is people record the value of the entire building as either 39-year property or 27.5-year property. That's what's on the depreciation schedule, and they're losing the benefit. Like, the technically correct way, according to the IRS, is to allocate the costs to the various components and not lump it all together. The IRS isn't going to care because your deductions are going to be smaller over a longer period of time, but the correct way to do it is to use a cost segregation study. So what are some of the benefits? Well, we've already mentioned faster depreciation, which leads to larger deductions in the early years. A cost seg study is typically going to carve out about 20 to 30% of that building cost and allocate it to 5, 7, and 15-year property, so personal property or land improvements. Also, now we still have bonus depreciation. So bonus depreciation, it was 100% up through 2022 and 80% in 23. The time this is going to air, 2024, it's 60%. It's winding down, and eventually it'll get to zero in 2027. But while we still have bonus depreciation, remember, bonus depreciation applies to assets with a useful life of 20 years or less. So when you're allocating those building components into 5, 7, and 15-year property, they're eligible for bonus depreciation. So you can really supercharge that year one deduction. So we have the cost seg study done. We allocate costs to the 5, 7, and 15-year property. Now we use that bonus depreciation to really supercharge it. So let's talk about some actual numbers to give an idea of what this would look like. So let's say you buy an apartment building valued at $1 million, excluding land. So whatever the total cost was, after you allocate value to land and building, we have $1 million assigned to the building valuation. This is residential real estate. So that's going to be depreciated over 27 and a half years. So $1 million divided by 27 and a half, that gives you a depreciation deduction of about $36,000 a year, just over. Now let's say you have a cost seg study done, and of that $1 million building valuation, you get $150,000 assigned to 5-year personal property and $100,000 to the 15-year land improvements. So the remaining balance of $750,000, that's still going to be depreciated straight line over 27 and a half years. So we got a 25% allocation from this cost seg study to the 5 and 15-year property. Just based on this, with the cost seg study alone, with no bonus depreciation, our first year depreciation increases from $36,000 to just over $62,000 using regular makers on the 5 and 15-year property. So that's roughly a $26,000 increase just from using the cost seg study without bonus depreciation. Now we have bonus depreciation to consider. So 2024, this cost seg study is done. You're going to be able to write off 60% of that 5-year property valued at $150,000 and 60% of the 15-year property valued at $100,000. So now we have that first year depreciation plus the $750 depreciated straight line over 27 and a half years. That itself is $27,000. In total, we're looking at a year one write-off of $177,000 because we have bonus depreciation. 60% of the $250,000 allocated to 5 and 15-year property, plus $27,000 straight line for the building portion that is allocated $750,000. So a pretty significant increase by using the cost seg study combined with bonus depreciation. Now, the first year write-off using bonus depreciation that's one of the big reasons to do this. However, there are other benefits to cost segregation studies. One is called a partial asset disposition. Now, next week, we're going to talk more about partial asset dispositions, but just know when you replace a component of a building, you're replacing a part that was acquired generally with the original purchase. So if there's an undepreciated value there, you can write that off using a partial asset disposition. But to do that, you need to have a value assigned to it. And generally, that's going to be performed with a cost seg study. So getting a cost segregation study up front is always worth it. You're accelerating depreciation, even if, let's say, you can't deduct your losses. You're not a real estate professional, or this isn't a short-term rental in which you materially participate. You're subject to the passive activity loss rules. Remember, the passive activity loss rules, they prevent you from deducting your real estate losses unless you qualify for an exception like real estate professional or short-term rental where you materially participate, or maybe you dispose of the property. But you have these suspended losses out there, okay, so you can't write them off against active income. However, those suspended losses could be used when you sell the property. You can do sometimes called a lazy 1031 exchange, but really it's just, someone that's thinking. They look at their suspended passive losses rather than go through a 1031 where you're subject to timing rules. You might be able to use your suspended losses to offset the gains from the property sale, again, as long as the purchase of the new property occurs in the same year, then you can absorb those losses. Or you can do the inverse where, let's say you sell a property, you don't have any suspended losses. You sell a property, you have a gain, you couldn't complete a 1031 exchange for whatever reason. You can buy a new property as long as it's in the same tax year, do a cost seg study, take that accelerated depreciation and offset the gains from the property that you just sold. So a lot of benefits to a cost seg study. Another thing to consider is that a cost seg study doesn't have to be done the year you purchase the building. Let's say you bought a building back in, 2020, where 100% bonus depreciation was in play. You bought that, we can use our example, that same $1 million building where we did a cost seg study, allocated $150,000 to a 5-year property and $100,000 to 15-year property. You didn't have the cost seg study done then, maybe you didn't know about it. And here we are in 2024, you could have that cost seg study done now, and bonus depreciation is going to apply based on the placed in service dates. You placed it in service in 2020, you can still use 100% bonus depreciation. Now you'll be required to file a Form 3115, an application for a change in accounting method, but you can take all that missed bonus depreciation in the current tax year and really build up your bonus depreciation write-off, your deductions for the current year, because you're going back in time essentially and pulling all those deductions into the current tax year for whatever reason. Maybe you need to offset a gain. Maybe you qualify as a real estate professional now and you just want to use those losses to deduct against other active income. Whatever the case may be, that is an option. So cost segregation studies are a very, very powerful tool. They have a wide range of benefits, and especially when you use them in combination with bonus depreciation, you're really going to be able to enhance your deductions. So just to recap, a cost segregation study reallocates the cost or the value of the building into shorter asset lives, such as 5 and 7 year personal property and 15-year land improvement property, and allows you to really enhance those early year depreciation deductions. When you combine it with bonus depreciation, then you really increase that year one value, your depreciation write-off. And they have other benefits such as partial asset dispositions, because you've got all the building components broken out on your depreciation schedule. The work's already done. You can easily identify the assets being disposed. And if you need to, you can always go back and perform a cost seg study on a building based on the place and service date, even if you didn't have it done originally. So that about does it. I hope you found value in this episode. If so, please leave a 5-star review or hit the like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.